Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. This video is going to be focused on the S&P 500 that has shown quite a bit of weakness over the past couple of weeks, and that's making a lot of investors right here very nervous as to what's going to be happening next. Are we going to break below that 100-day moving average and begin dumping down to lower support levels? Now, we do think that we're coming to the end of a large bull run on the S&P 500. We've seen absolutely massive returns since that 2009 low here throughout the past 12 years here. If you take a look at the 10-year cycle of the S&P 500 in terms of the real returns adjusted for inflation, we've had very, very strong returns with low inflation, and we're most likely coming to the end of that cycle. You can see here that we're getting into that upper end of the historical range that we've seen throughout the past 100 years. But the point I want to start off on this video here is that we're not in particularly overextended conditions. We could still have some room to run over the next few months as we see that big end of cycle peak around next year. And typically that last part of the bull run, right, the late 1920s, the late 1950s, the late 1990s, those are the periods where you get the most amount of gains in the shortest amount of time. That's when you can get speculative bubbles. Valuations go to extremes. And so we don't think that we've seen the top just yet, and we're about to see a lot more crazy moves heading into the end of the year that could prove to be very, very profitable. Now, in this video, we're going to be focusing on this short-term correction that we've seen over the past couple of weeks and take a look at a few different charts and indicators that may tell us whether we're about to see a lot more short-term downside or if we're going to be making a big bottom here and heading higher. Now, if you're interested in following these crazy markets with us, make sure to smash that subscribe button. And now, without further ado, let's get right into it. All right, so this is the S&P 500. You can see we've been trending down over the past few weeks here. So let's take a look at what the markets are pricing in here. And one of my favorite indicators to do that is J&K divided by TLT. Now, J&K is the high yield bond ETF. It's also called the junk bonds. So it's low quality bonds that we're looking at here. And we're going to be dividing that chart by TLT. So that's the Treasury bond ETF, very safe bonds. We've looked at this quite a few times over the past few weeks because this gives you an idea of what market participants are pricing in terms of the credit risk. Can we expect a lot of defaults over the next few months? Are investors flowing away from high risk bonds and flowing into safety? Or are we seeing more money flow out of the safety and come into riskier assets? And the answer to that is that we're seeing a flow out of safety, meaning the J&K divided by TLT ratio is rising. Now, the big reason for that is because we're seeing Treasury bonds sell off. This is part of our end of year thesis that we've been talking about, is that we're expecting a risk on move, and seeing J&K divided by TLT rise here is telling us that we are in a risk on environment, that investors are more attracted to junk bonds than Treasury bonds. So it's very interesting to see this indicator flash risk on. But if we add the S&P 500 on here, the stock market is telling us the opposite thing. So we have this divergence between stocks that are going down and this risk indicator going up. Now, I'm not very used to this because this is a very, very rare signal that we're seeing here. Typically, the type of divergence you can get is stocks going up, but this ratio going down, right? That's the type of divergence that you can get, and that usually tells you that credit risk is rising because J&K is falling relative to TLT, but stocks are still going up, and that's telling you that you're about to see a big move down in the stock market, or at least a significant correction, right? And you can see that over and over again. For example, here in 2015, you had this big drop in J&K divided by TLT right before that big drop in the stock market. So this is a leading indicator of market corrections. So what this essentially means here is that this is a positive development for the stock market. that the correction we're seeing in stocks has no real underlying cause except for some investors panicking about China, about the debt ceiling, about maybe tapering, but no real cause that is being priced in by the bond market. And so again, that tells me that this correction is not going to last very long, and we're soon going to be making a big bottom here. Now take this with a grain of salt. Nothing is 100% in the markets, but this is a rare signal, and I believe this represents a unique opportunity to take advantage of the next leg up here, right? Keep in mind that we're in a bull run here. We have incredible momentum in the stock market, and dips are going to be bought. We've got easy monetary policy. Don't underestimate how far this can go. Now, if you like the effort that's being put into these videos, make sure to smash that like button. It really gives our videos that extra boost we need to reach new audiences, so that's really appreciated. Now again, just to highlight this opportunity a little bit more, we can take a look at the fear and greed model that remains extremely fearful here. We're hovering around this extreme fear zone that you tend to only see at big market bottoms, right? We only saw these at the bottom of major corrections. So again, that's just something to keep in mind when looking at the S&P 500. You don't want to be with the rest of the herd. Now, one development that I do believe I'm going to need to cover in this video is the US dollar currency index. It's been breaking out recently. It's making a lot of investors very nervous here regarding the potential impact that could have on the markets. Now, the reason the dollar is so important and so many people look at it to evaluate the stock market is highlighted on this chart here. This is the US dollar currency index, and this was actually a premium post that we made for our members on gameoftrades.net, where we took a look at all the periods where you had big downtrends in the dollar and highlighted those zones in red, and big rallies in the dollar are highlighted in green. And we overlaid that with the S&P 500, you can see here, and you quickly see that relationship where the red zones have very strong returns in the stock market and the green zones have low returns in the stock market. So I'm going to give you guys my opinion on what's happening here and whether that could have an impact on the stock market. But before we look at that, I want to take a look at some of the bigger picture stuff. And I want to begin by looking at leading economic indicators. This is a chart highlighting leading economic indicators and the real GDP. Now, the actual indicator here, the leading economic indicator, is that blue line you see here. And it leads GDP. And of course, the concept behind looking at this is that it leads GDP. It predicts what GDP is going to be. Now, that indicator is composed of just a bunch of different indices and data like the average work week, building permits, credit index, interest rate spread, a manufacturing index. And so it's a great predictor of recessions. Right before major recessions like 2008, like 2000 here, you have this leading economic indicator dip below that zero line. And that happens systematically right before the recession begins. You would have seen that cross below the zero line in 2007, right at the top of the stock market bull run. So right now we're seeing a lot of non-justified fear right now. Economic indicators are still pointing up for now. We're not seeing signs that the economy is rolling over just yet. Now that's a great example of one of the many types of indicators that we look at on gameoftrades.net. We look at so many different pieces of data, different indicators, different relationship between assets, bonds, stocks, dollar, industrial metals, and market health indicators, economic indicators, to really give you a full and complete overview of what's happening in the US economy and how that's going to have an impact on the markets. But what I do believe is the most important aspect of our website is that we go through the actual thought process that's needed to put all those pieces together and form our convictions and a plan to take advantage of the market moves. Now, don't get me wrong, we'll eventually see that leading economic indicator come down and test that zero line and perhaps dip below it and enter recession territory and see other indicators that we cover on our website start to flash some red signals. And when we do, we have every intention on preparing ourselves and preparing our members for the coming downturn. But for now, we think that fear mongers are very, very early to predict downside in stocks and could miss out on quite an impressive run heading into the end of the year. Now, next week, we'll be doing a complete overview of where we think the economy is in terms of the actual indicators, in terms of monetary policy, what the banks are doing, and at what stage of the economic cycle we think we're at, and how to position for that. I think the value of everything that we provide on our website in terms of the potential profits and in terms of the education that we have on here, because all of these articles are designed to help you understand the markets better. All of this is just for a ridiculous price. So again, we're trying to give access to the website to as many people as possible for the current price. Make sure to go and grab yourself a free trial if you're interested in checking out some of our articles and videos that we post on here. Now back to discussing the DXY, so the US dollar currency index that has such a profound impact on the stock market. We've been a little bit off on our US dollar call. We expected the dollar to reverse much sooner, and we did not expect so much strength on the US dollar. Now, we do think that we're still in a dollar bear market. If we take a look at the twin balance as percentage of GDP, the government has been in a massive deficit over the past year here, and we believe that's going to continue to put pressure on the dollar over the next few months. Now, if you look at the sentiment on the US dollar, this is the chart of the US dollar sentiment, and you can see here that we're spiking into bullish territory for the first time since the beginning of 2020, before the pandemic. This is the first time we're seeing that bullish reading. Now, I find that very, very interesting, because if we go back to the previous dollar bear market between 2000 and 2008, you can see the counter trend rallies. What happened on every counter trend rally on the dollar? Boom, you get a bullish reading, and then the price reverses. Boom, you get a counter trend rally, bullish reading, and then the price reverses and comes back down. So we might be starting to get a little bit of capitulation here as investors capitulate into the dollar. But if we keep a broader perspective here, and we actually take a look at what this rally is in relationship to this move down that we saw, and we take a look at the fib retracements from the top of this move to the bottom of that move, you can see we're only testing the 38.2 retracement level here. That's a typical retracement level for a counter trend rally. This is going to act as resistance, and we can also draw a nice trend line on this chart here from these reactions, capturing that low here and capturing these reactions as well. Look at this: bounce, breakdown, retest, and now we're retesting that level again. So we'll see what happens on DXY here, but if we have a powerful rejection of the 38.2 retracement level of the trend line resistance and following that bullish capitulation on the US dollar, perhaps that's going to lead to a weaker dollar environment over the next few months. We'll be watching that very carefully, but that is our base case right now. Now, I hope you guys enjoyed this video. If you did, make sure to like this video and subscribe to the channel as well. In the meantime, I wish you good luck on your trading, and see you next time.